Hello friends, I welcome you all for today's value investing video. In today's video, I am going to show you the target price of Reliance Industries after 1 year. Okay, without wasting time, I will directly go to the Excel sheet. In this Excel sheet, I have calculated the 1 year target price of Reliance Industries in 4 methods. Let us learn one by one. In this method, I have calculated the Reliance price in revenue growth method. For this we need so many data for calculation. These data can be obtained from annual report of any company. So I have taken so many data of Reliance Industries annual report. Before that, I need the weighted VAP of Reliance Industries. You can take the last traded value of Reliance Industries also. But what happens in the market is the prices will be continuously fluctuating for different reasons. So it's better to take the VWAP of 3 months or 6 months, whichever you need. Here I have taken last 3 months data and calculated the exponential VWAP. If you want to know how to calculate the exponential VWAP, let me know in the comment box so that I can make a video on how to calculate the exponential VWAP using 3 months or 6 months data. After calculating the XVWAP, we need to know the total number of shares of Reliance Industries. These data can be obtained from BSE website. So this is the total number of shares of Reliance Industries. With this we can calculate the total market capitalization. This is the formula for calculating the market cap. That is total number of shares divided by VWAP, whole divided by 10 raised to 7. That will be the value in crores. Then I have calculated the TTM revenue quarter on quarter using 4 quarters. This data I got from Money Control website. You can get it from Money Control or Screener or any other websites. So I have taken the 4 quarters revenue of Reliance Industries, that is quarter September 20, June 20, March 20 and December 19. So I got with this data the total trailing month revenue of Reliance Industries. Calculating the TTM revenue is always better than the revenue of last 4 years or something. This will be the latest value. I got the value of 4,76,941. It's always better to take TTM revenue rather than year-on-year revenue. So this will be the latest value. Then we can calculate the revenue multiple. This is the total market capitalization divided by TTM revenue. We will get revenue multiple. After this, I calculated the revenue growth, that is CAGR. To calculate CAGR, we need 4 years data. This we can get in annual report of any company. And this annual report can be downloaded in Google. You can just Google out annual report of any company, PDF format, you can download. Total revenue from operations can be found in annual report, that is in consolidated balance sheet. Then using a CAGR formula, we can find out the CAGR of revenue, that is year on year, and I found out as 22.58%. Then using this CAGR percentage rate, we can estimate the value of revenue for future years. Using what if analysis, or we can say scenario analysis, we can calculate the expected growth rate. We can keep the actual growth rate itself, but to be more conservative than aggressive, I considered one more scenario, that is taking 90% of the actual CAGR. Then I calculated the expected value of revenue. Using this method, the estimated value of revenue can be calculated. Here I have taken 2 scenarios, that is actual scenario and at 90% of the actual growth rate, because the markets will be fluctuating always in nature. So it's better to take more and more scenarios so that we will be in the safer side. So here I have calculated and estimated the revenue for actual growth rate and at 90% of the actual growth rate. Here you can take your own percentage value as you monitor the value of any share so that you are more conservative. For actual CAGR, the estimated value of revenue will be 5,84,682, and for 90% of CAGR, it will be 5,73,881 rupees. Of course, the values are in crores. Then we can calculate estimated market capitalization using the formula estimated market capitalization multiplied by revenue multiple. So revenue multiple was 2.8, and we multiply it, we get 16,44,389 and 16,14,094 for 90% of actual CAGR. Then we can calculate the price per share, that is estimated market capitalization into 10 raised to 7 and divided by total number of shares. Here we are calculating in crores, so it has to be multiplied into 10 raised to 7. So you will get the price value per share for actual CAGR is 2,431 rupees, and for 90% CAGR 2,386 rupees. So then I have taken the average of these two values. Then I got the final value of 2,409 rupees. Now I will do an EV by EBITDA method. To do this, we need XVWAP, that is exponential VWAP per share, which we have already calculated for last method, and the total number of shares also we have. Then market capitalization is multiplication of these two factors. Then for debt calculation, borrowings details has to be computed. The borrowings of any company can be found in the consolidated balance sheet of any company's annual report. Here I have taken current liabilities and non-current liabilities borrowings. To get the total debt, we have to add current liabilities and non-current liabilities values, and by this I have got 2,91,417 crore rupees as debt. Then to calculate CCE, that is cash and cash flow equivalents, this data also we can get in annual report of any company. To get total CCE, we have to add CCE and bank balance both. So I got 31,890 crores. Then we need to calculate net debt. So to calculate net debt, we have total debt and CCE. We have to subtract the CCE from total debt. Then we will get the value of net debt. See here, I have subtracted the value of CCE from total debt and got to the value of net debt, that is 2,59,527 crores. Using this, we can calculate the enterprise value. Enterprise value will be addition of net debt and market capitalization. Here the net debt is 2,59,000 something is there, and this is the market cap. Sorry, I have typed total number of shares instead of market cap. So this you have to take it as market cap. This is not total number of shares, it is market cap. Then it has to be added with net debt. Then we will get enterprise value, that is 16,967 crores. So this is the market cap. Now we need to calculate TTM EBITDA of 4 quarters. So it's better to take the latest value of TTM EBITDA so that our calculation will be more accurate. So for this we need depreciation values and profit and loss before interest except items and tax values. Again, these data are taken from annual report of Reliance Industries. So we have to add depreciation plus profit and loss before interest and exceptional items tax to get TTM EBITDA. So with this we can calculate EV by EBITDA value, that is 19.96. Then we need CAGR of EBITDA. To get this, I have taken the EBITDA value of last 4 years, that is March 17, 18, 19 and March 20. annual report. So here we need to calculate PBT, then depreciation and interest, finance cost and other income to get the EBITDA. For every year I took the data of various values in annual report. So to calculate EBITDA, we have to add PBT plus depreciation plus interest or finance cost, then minus other income, then we'll get the EBITDA. So in the same way I did for all the years 17, 18, 19 and 20. With this we can calculate the CAGR of EBITDA using CAGR formula. So I got 24.1% of EBITDA CAGR. So this CAGR formula is for 4 years, and we can also calculate the PBT CAGR also. We got 13.0%. And with this data we can calculate the growth rate of EBITDA and expected EV, everything. Here also I have taken 4 scenarios, that is actual growth rate and 80% of actual growth and 70% and 60% of actual growth rate. I am considering more and more scenarios so that I will be more conservative in the price than aggressive. So for estimated growth is a different percentages will come, and the estimated EBITDA for actual growth rate is this one, and estimated growth rate for 80% CAGR is calculated, and 70%, 60% also calculated in the same formula. Then expected enterprise value is calculated. If we multiply the EV by TTM EBITDA multiple into estimated EBITDA, we will get the expected EV. So by this method I got expected EV for actual CAGR, and the same is applied for 80%, 70% and 60%. Then expected equity value we can calculate using the formula. So that is expected EV minus net debt. This is the formula for expected equity value. I repeat, the net debt has to be subtracted from expected EV, then we will get the expected equity value. It is applied for 80, 70 and 60% scenarios. Then equity value per share can be calculated using the expected equity value and the total market cap. So this is the market cap, not the total number of shares. So when we divide it by market value, we get the equity value per share. In each scenario I got different share prices, so I averaged these 4 values and got 2,425 rupees of final value using EV by EBITDA method. Now I will calculate using PE method, that is price to earning method. For this I need the total TTM PAT of 4 quarters. This data can be obtained from Money Control or Screener websites. Here we have to check P&L after tax from ordinary activities. So the total of PAT is 41,782 crores. Then we need to calculate TTM PAT growth quarter on quarter. So for this I need again 4 quarters data. Again I got it from Money Control website. To calculate the CAGR of PAT, we need 4 quarters data. So I got 20.34% of CAGR with CAGR formula. Then market capitalization we also know. In the previous 2 methods we have used, that is in crores, and the PE multiple of Reliance Industries is 32.11. This value we can get in Money Control or Screener. So now we have TTM PAT of the company and the PE multiple and the PAT growth rate. So with this we need other data like P to BV value and P to E value of its peers, because we are going to compare the share price of the Reliance comparatively how much high or low to its peers. So for this we need the peers data. This data we can get in screener.in. So the market P to book value is 1.02. I have averaged all these P2PVs of different companies which are peers of Reliance Industries. Then I have taken the PE multiple of two companies, that is average value is 10. So as much as data is required to estimate the different values for any company, so I have took PE, P2BV also. So then in inward approach we will be estimating the value within the company, that is TTM PAT of Reliance Industries, and it is compared with the peers data also, so that the share price comparatively more accurate for our calculation. Then TTM PAT we got the calculation, that is 41,782. In scenario A we are considering 90% and scenario B 70% of the actual growth rate. So again here the PAT growth is 90% and 70% is considered, because when we consider more and more scenarios we will be safer side always, so that we are not aggressive and estimating the value at higher side, not higher side, but we are estimating at comparatively lower side, so that we can buy any share in a comfortable price. So this is the 90% of actual CAGR and 70% of actual CAGR. The same is applied for peer comparison also, 18% and 14%. So the estimated PAT will be the PAT growth rate at 90% into TTM PAT. So it will become 49,430 crores. Then the same formula is applied for scenario B and PR analysis of scenario C and scenario D. Here also we have to multiply the TTM PAT into PAT growth, which I have calculated as per the formula. And for scenario D, 47,730 is the value. Then expected market cap can be calculated with the help of the formula, that is PE of the Reliance Industries multiplied by estimated PAT. So we will get the expected market cap. In peers comparison, we have to multiply the estimated PAT into the peers P to book values multiple, that is the average value 1.02 we got now. So this has to be multiplied with the estimated PAT, so that we will get the expected market cap in the peers data comparison. Then we can calculate the price per share, that is the expected market cap divided by total market capitalization. So then here we will get the value of price per share in different scenarios. So this is the total number of shares. So we got values for 4 scenarios. Here you can observe that in peers data the value is very less. So I gave the weightage of 0.3 for inward approach and 0.8 for outward approach, so that the peers data is more close to the inward approach. Here the price is less because the P to book value of market is 1.02 only, but Reliance price to book value is 32.11. So when we give different weightages for these values, we have to add all the weighted values to get the price per share. So I have added these 4 values to get price per share in PE method. So this is the value by price to earning method. Now we will calculate in book value method. For this we need again market capitalization and weighted X VWAP per share, then current book value of the company, and with the current book value and weighted VWAP we can calculate price to book, that is total market cap divided by X VWAP. We got 2.05. This is the ratio, it is P to BV. Then the industry price to book value we have already calculated in the previous method. Then we need book value of 3 years back and 5 years back to compare how the growth rate is in the book value. So book value growth rate can be calculated using this formula for 3 years and for 5 years. Here also I did 4 scenario analysis, 2 for inward and 2 for peer approach. So expected book value is 30.66% when we compare with 3 years book value and 23.6% for 5 years. The same is applied in the peers comparison also for scenario A and scenario B. Here scenarios are 3 years book value and 5 years book value. So total expected market price will be 2,591 for scenario A and 2,452 for scenario B. To get this, we need to multiply the price to book ratio into expected book value, so that we will get the expected market price. So this is peer comparison. According to the formula, we got a little less than the industry. PB is very less compared to Reliance PB. So we got less price in peers comparison. So I have given more weightage for peer comparison so that it is more close to my Reliance company's P to book value. So the calculated price will be more accurate when we consider more and more scenarios and give weightage. So these weighted values has to be added to get the final price. In this method we got the final price of 2,766 rupees per share. Now I will calculate the final expected price after 1 year. Here we have 4 values for different condition, that is price to sales, EV by EBITDA method, and price to earnings, and price to book value methods. So all these 4 are different values. So I will give equal weightage for all these values so that I will be considering the weightage value of all these methods. Here the weighted values are added and final price is 2,535 rupees. This will be the value after 1 year. So current market price as per 15th of January 2021 was closing price was 1,937. Here also I have took 2% less than the actual price, so that I will be safer side when we expect the value. So 2% less means only 98% of the actual I have taken. So the expected range of the price will be 2,484 rupees to 2,535 rupees by next year. That is 28.3% of the current price, and maximum price will be 30.9%. Somewhere these two values this has to touch by the next year. So these all 4 methods are very useful to analyze any company's 1 year's future price for retail investors, and these methods are very easy if you have annual report and money control screener websites. You will get all the necessary data and you can easily calculate it. So friends, these calculations are according to the data of 4 years and TTMs of Reliance company. I did my own analysis. You can also do your own analysis before buying any share. Instead of buying any share blindly, if you do these analysis, then you will be having some idea how much gain you may get. That's all for today. Thank you and happy value investing. Please like, share and subscribe to my channel to be a value investor. Thank you and bye-bye.